Hello, everyone. Welcome to the Patty Brennan Show. Whether you have $20 or $200 million, this show is for those of you that want to protect and grow your wealth to live your very best life. My name is Eric Furman, Chief Planning Officer here at Key Financial, and once again, I get to step in as your guest host of the Patty Brennan Show. Today, we have a really great topic that I'm excited about, and I think it's very timely because we're in the month of December. Today, we're here to talk about RMDs, or as my dad likes to say, MRDs. So however you switch the acronym around, what we're talking about here is required minimum distributions. Okay. And this is a really important topic, especially in the month of December, because number one, if you don't take out the proper amount, there is a 25% tax on the undistributed amount that should have been satisfied. So really important to make sure that's done before year end. It's also important because an RMD is taxable income, which adds to other sources like Social Security, pensions, and any other income you might have. So that just exacerbates your tax problems. So you want to make sure that you properly planned and withheld the appropriate amount of tax so you don't have an unfortunate surprise come April 15th. And lastly, most important is it represents a terrific opportunity, especially for those who might be charitably inclined, to really make a difference with an organization that is important to you by using those RMD dollars to make a charitable gift to an organization that you care about. And the benefit is that it satisfies the RMD, it reduces your taxable income, and potentially reduces the IRMA, or income-related monthly adjustment amount, that might be applicable to your Medicare Part B and D premium. So a great opportunity here, and we've got a great show for you. And joining us on today's show is a very special guest, one of our internal champions who works right by my side in the planning department. Ladies and gentlemen, please welcome Kelsey Girafalco from the planning department, sits right behind me. She is absolutely fantastic, and so excited for you to be on the show today, Kelsey.
Yes, thank you. I'm excited to be on the show as well.
This is an exciting place. I don't know about you, but I mean, just being here, it's just, creative, and it's always a lot of fun. Yes. So, Kelsey, you have a lot of practical experience and working with our clients. I mean, you've been here for so many years. You've seen a lot of situations. So what would you share with the listeners in terms of really kind of the most important thing or something that sticks out to you as it relates to educating and helping the audience here today think about required minimum distributions?
Yes, so that's a great question. I think one of the things that we often look at is their clients' cash flow needs and whether or not they are going to need to take, well, they have to take the income, but whether or not they need the income is another thing that we look at, and we take that into consideration before they are starting taking required minimum distributions. And if they want to take the distribution monthly, annually, quarterly, how it fits into their cash flow needs.
Yeah. So there's a lot of decisions to be made there, right? So It's not just about, okay, there's this amount of money we need to take, but I guess the question is, are their needs satisfied through some other means? Yes. How do you pay taxes? And when do you distribute it, right? So there's a whole bunch of things you have to deal with. And it's, I mean, just think about it, though. I mean, you have to go through those decisions for every single person, So I feel like this is an element, and I'm sure you might agree here, it's very kind of tailored, right? It's customized.
Yes. Yeah. I mean, every person's situation is different, so you have to take that into consideration.
Yeah, well, that's what we do here, right? So that's kind of our specialty is personalization. Yes. So, why don't we break it down for listeners out there? Okay. Because we always want to, be sure that we're providing education and insight, even when it comes to the most rudimentary elements here for the RMD. So, for those of you out there, the RMD, or required minimum distribution, what exactly is it? So you have to realize that long time ago, when you decided to start saving in a qualified employer plan, or let's say opening up a personal IRA, you were essentially engaging in a partnership with the United States government. And that partnership works as follows. They allow you to defer taxes on your contributions and investment gains until you reach a certain point, now age 73 to 75. At that point, now you, the account owner, are obligated to engage in your part of the deal, which is to begin distributing money and paying taxes back to Uncle Sam. So really the required distribution is just you fulfilling your end of the bargain, if you will, with the U.S. government. Now, the question here is, when do you have to take it? And I think this is confusing for some folks because the government has continued to move the goalposts here.
Yes.
You and I have been around long enough to kind of remember when it was 70 and a half.
Yeah.
I mean, we're kind of showing our age, I guess, in a sense there. But it was 70 and a half, and then it went to, what was it?
72.
72.
Yep. Yeah.
And then the Secure Act came along. They made things complicated again, and now it's between 73 and 75. So now we have this range. So for those of you out there, all of this stuff is tied to your date of birth. So to really kind of make it personalized for the individuals. So if you were born before 1960, then you're required to start distributions, what they call your required beginning date, at age 73.
Yep.
But if it is post 1959, then it is 75 when you have to start taking these distributions. And again, the term here is required beginning date. That's the date when you have to commence benefits. But 73 to 75, depending on whether you fall on the left-hand side of pre-1960 or on the right-hand side. But then it's even more complicated than that, right? Thanks to our the new laws out here. So inherited IRAs. So how do you, Kelsey, kind of navigate the different possible pathways when it comes to inherited IRAs? Because that is even more seemingly complicated.
Yes, it did complicate it once they changed it to the Secure Act 2.0. We keep track of, I don't even know how many that we have total, but you have to, it really depends on the decedent's date of death, which if they died after 2020, you have to have the whole IRA distributed within 10 years, except if there's certain exceptions. There's certain exceptions that you can have that would change how the distribution is taken. But I think we're going to touch on those a little bit later. But basically, if you inherit an IRA after someone passed away after 2020, you have to distribute within 10 years. And if the person that passed away was taking a required minimum distribution at their time of death, then you are also required to keep taking a minimum distribution within those 10 years.
Right. Yeah. So now again, we have this kind of, these different pathways that emerge. It almost kind of reminds me of being a kid when you read that Choose Your Own Adventure book. It's always like you're given a node and you have to make a decision, and that kind of determines which direction you travel. So I think I've seen it out there, folks. There's some great charts on this that help you kind of answer those questions and then just follow the path based on your answer to the questions, which is something we use sometimes because it can, even for us, it can get very complicated. Now, I guess here's the good news. The actual calculation of the RMD is pretty straightforward. It's basically a division problem here where we're taking the December 31st value of the IRA, and then you're just dividing it by a life expectancy factor, really. So there's just two inputs here, and that determines your RMD, and you continue to do that each and every year. So that's the good news. But I guess, Kelsey, when you think about this, where can this get complicated? The life expectancy factor. For most people, we're using something called the Uniform Lifetime Table, or what they call Table 3. So that's where most people are going to be. But what about, maybe some special situations where the life expectancy factor might be different? So why don't you maybe kind of educate our audience on what those circumstances might be?
Yeah. So, one of those circumstances is if your spouse is more than 10 years younger than you, you're going to be using the joint and survivor table. Another situation, and this has occurred, but if you inherit an IRA, there's situations where you have to use the single life expectancy table. And I kind of touched on this when we were talking about inherited IRAs a little bit ago, but you also, it will change depending on whether you're an eligible designated beneficiary or a non-eligible designated beneficiary.
No goodness. Right. So again, we just keep going down the rabbit hole here. But it is important, there's three different tables. Most people would use the uniform table, but there are exceptions depending on your circumstances. So, and again, the essence here is you don't want to calculate it improperly. Is the big thing. Now, what about is if things, the calculation is easy, but there's a lot of things to consider. What about people that have, multiple IRAs, or they might have IRAs and also old 401k savings plans. I mean, I think that really kind of makes it challenging, I think, in terms of just figuring out and processing your RMDs. So, what kind of experience have you had there when you run into those situations?
Yeah, so a lot of the times, and it does depend on the institution of where your IRA is held or where your 401k or your former employer-sponsored plan is held, but most of the time you can aggregate your required minimum distribution together and take it out of one account. Sometimes the institution requires you to take it out of that account that you have held with them, which is perfectly fine. If you just need to make sure that it's done before 12/31 of that year. So
right. So basically, for anybody out there that might have multiple IRAs, but they hold them at 2 or 3 different institutions.
Yeah.
You have to ultimately, my understanding is the taxpayer bears the responsibility to make sure they are calculated and distributed appropriately. Although I guess some institutions will do it as a courtesy, but again, the individual bears the responsibility.
Exactly.
To make sure
most of the responsibility is on the individual. For our clients here, we take care of making sure that that is done before. We don't even let it get too close to 12/31, but we start heckling and bothering them to make sure that distribution is processed before year end.
Yeah, and I think too, you've probably gotten this feedback as well. But I think that's where people tend to find a lot of value in consolidating everything from different institutions or old 401k plans, even though you're not required to roll them over in most cases. The benefit of consolidation is really the simplicity and just really streamlining that phase of life when now you have to do these calculations and distributions. And let's not forget, this is taxable income. So you also... while you're not required, you also have the option to withhold taxes from the RMD. And I think in our case, I think that's where there's a lot of ambiguity for clients, which is, well, how much do I withhold? I don't even really know what my tax liability is because it's a complicated picture that includes other income besides the RMD. So I guess, how do you kind of help people navigate that end of it? Because the tax withholding is an important piece because people usually they like a refund, but nobody likes to have to write a bill to the IRS.
Yeah, for the most part.
But I think certainly we can be helpful in that regard. So, how do you kind of provide value and help people through that?
Yeah, that's a great question. So I think a lot of the times we take a look at their income for the year. We're going to want to look at what capital gains or dividends, interest. We kind of looked at all of that collectively to see what tax bracket they're in and what the tax withholding makes sense. A lot of the times we'll work in collaboration with their accountant, or if they do their taxes themselves, we'll kind of run through what we're thinking. And it also depends on what state that they live in too. In the state of Pennsylvania, retirement income is not taxed, so they don't have to worry about withholding anything, but we would look to see what state they are in and if they need to withhold taxes. Some states require it, so you don't have the option, but that's another part of it too. Yeah,
that's actually, this is a bit of an aside here, but that's kind of a big issue too, because if you worked your entire life in Pennsylvania, you didn't get a deduction when a state tax deduction when that money went into a retirement plan. But they don't tax it when it comes out. So if suddenly you pick up and move to a state like Delaware or Georgia,
Virginia.
Now all of a sudden you're paying, it's almost like double taxation. You didn't get a break when you saved the money, and now you're paying taxes again when it comes out. So I think that's for us when we're doing planning and people are considering maybe moving, in retirement, it's a relevant consideration. But no, that's all good stuff. And I would just add to that too, what I also tend to find is when we're doing that tax analysis, a lot of interesting things come out where we find that people aren't withholding tax on, say, Social Security, or they're holding at a very low rate on a pension. And really the RMD is the opportunity to kind of true up the tax withholding to cover the under withholding on all the other sources of income. So that way people don't end up with kind of a nasty surprise. But that all comes from the relationship, being proactive, and I think, really just to kind of round out our discussion here. And unfortunately, folks, I apologize. Really exciting topic, but there's just not enough time unless we broke this up into probably 4 or 5 series, which maybe we'll do.
Yeah, who knows?
To really address it all. So very high level here. But, if you can just kind of share with people here, what does a proactive approach look like? And I think for us, we kind of think about it in two phases. There is that phase leading up to RMDs before they actually start,
Yes.
where we're trying to do proactive planning, maybe Roth conversions, and then there is kind of the post RMD part where now they're taking it out and we're thinking, okay, how do we manage it with cash flow? But also, are there charitable opportunities like QCDs? So I don't know, share a little version, I guess, of maybe both of those.
Yeah. So, a lot of the times we are looking every year, especially this time of the year, to see prior to a client starting their required minimum distribution, if there's tax opportunities as far as like Roth conversion or capturing capital gains in at 0% or 15%. But we generally start to also touch base with those that are going to be starting required minimum distributions next year to try to get ahead of it and plan for what their income is going to look like the following tax year. Some people they retire and they have no income, so their taxable income has been lower for a couple years, and then when they start taking required minimum distributions, it increases things like not only their tax bracket but also their Medicare Part B premium with IRMA. So we try to just reach out and help you be prepared for what to expect. And then we also want to let you know when the year you turn 73, we'll reach out and let you know the amount that you are required to take. One of the other things, too, as you mentioned, is a qualified charitable distribution. Now, you can start those at 70 and a half, but sometimes it doesn't always make sense to do it until you are taking required minimum distributions. So that's also something that we look for with clients to see if it makes sense. They're charitably inclined to kind of help reduce their income for the year.
Yeah, and I think, in that case, to the extent that people have the ability and the desire to use qualified charitable distributions.
Yeah.
I mean, really, to me, that's a home run. Everybody wins.
Yeah.
There's an organization, a need that provides a benefit that wins. That you get to lower your income and potentially lower IRMAs. Again, depends on your exact situation. And ultimately, you're fulfilling the bargain with the government, but they're not getting the tax dollars. Somebody else is essentially getting the benefit of that, and you're lowering your income taxes. Yeah. So all good stuff. Well, I guess at that, Kelsey, it's been fantastic. So thank you so much for joining us in studio today. Again, a lot to unpack, and there's a lot more that we didn't cover, but hopefully if you'll join us again, we'll be able to do another podcast and really expand on some of these related items to required minimum distributions. But I want to thank all of you generally for tuning in and listening to the program. If there's anybody that that could benefit from this information, please feel free to share this podcast with them. And I'd also like to encourage all of you, if you have questions, feel free to reach out to us through our website at www.keyfinancialinc.com or contact the office and feel free to reach out to us that way as well. But I want to thank all of you, and I wish everybody a happy, healthy holiday season and a prosperous new year. Thank you so much for joining us again on the Patty Brennan Show, and we'll see you again real soon.
The following presentation is sponsored by Key Financial Incorporated. The Patty Brennan Show is intended for general information purposes. Only any non-employee guest speaker who joins Patty Brennan on the show is a guest and is not an affiliate of Key Financial. Their remarks do not necessarily reflect Key Financial's opinions or positions. Key Financial neither prepared nor verified any portion of our non-employee guests' presentation content and has relied upon the accuracy thereof. No portion of the presentation serves as the receipt of or a substitute for personalized investment advice from Key Financial or from any other investment professional of your choosing. Neither the information or opinions contained in this or any podcast, white paper, or on Key Financial Inc.'s website constitutes a solicitation for the purchase or sale of any securities and should not be relied upon as financial, legal, or tax advice. Content may be outdated, and past history is no guarantee of future results or experience. Please seek appropriate counsel from qualified professionals who know and understand your goals, objectives, and potential vulnerabilities. Thanks for listening to The Patty Brennan Show, brought to you by Key Financial Inc., wealth management with wisdom and care. Securities offered through Osaic Wealth, Incorporated, member FINRA SIPC. Investment advisory services offered through Key Financial Incorporated. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.